All right, so good afternoon, everyone. All right, we know how this goes. I know we've all just had lunch, but I think we can do a little better. Good afternoon, everyone. Good afternoon. All right, thank you so much. Welcome back, everyone. I hope everyone is refueled and ready for some insightful sessions. I am very excited to introduce our next speaker, New York City Comptroller, Brad Lander. Comptroller Lander serves as the city's chief financial officer and the steward of one of the largest public pension funds in the United States. He and his team are leading institutional investor engagement on sustainability on topics such as climate and jobs. While much of their focus is on public markets, Comptroller Lander has also developed a cutting-edge approach to working with private market actors on sustainability. And on a more personal note, I've been able to see Comptroller Lander's innovation in action. The city of New York is actually a leader in this program called Making Rent Count and has championed the idea of using things like rental payment data as alternative data, which is now spread across the nation. So very excited for you to hear from a true innovator in this space today. But with that, please help me welcome Comptroller Brad Lander with a round of applause.
Thank you so much. Thank you so much, Samir. I really appreciate it. It's great to be in this room. I want to say a special thank you to Tensi Whalen, who I first met close to a decade ago and had no idea we would be doing this work together. But I'm really excited for it. I think this is work that is important and really underappreciated. There's obviously ESG and responsible investing have burst into public consciousness through the backlash against them more than really through any clear sense of what they were on the front side, but in a way that has really primarily been about public markets. And so the dialogue, what does responsible investing mean and what would it look like to be strategic and disciplined about it in private market space is something that obviously is pretty important if you care about responsible investing in the capital markets, but doesn't get a lot of serious attention. So I was gratified to have the opportunity. So I'm going to talk about the New York City retirement system's approach to responsible investing a little bit in general, but in particular focus on private markets. What we actually have are 5 funds. These are the New York City retirement systems: teachers, cops, firefighters, New York City employee retirement system, which is the broadest, and then a pretty small 5th one, which is the non-pedagogical employees in the schools, Board of Education retirement system. This didn't come through quite so well, but I just want to reflect, it's a very complex governance system. So each of these funds has a board. I am one trustee on each of them, but you can see they range from 7 to 27 trustees. The controller is the investment advisor and the custodian for all 5 funds, and for each of them, more or less, there are about half city trustees, me and the mayor and other city appointees, and half labor trustees, so that in order basically to do anything, to do an asset allocation, to make an investment, to pick a manager, requires getting votes from both halves, essentially, some from the city and some from the labor side. So it's always interesting. In a slightly better world, I think that would reflect that we actually have both a set of fiduciary obligations to our beneficiaries and a public fisc obligation to the city, because it's the city balance sheet which holds those obligations. As things work out legally, we are essentially guided entirely by fiduciary obligations. In my other hat, I think about making sure that the city is saving money as well. But when you think about some of the kinds of externalities that flow from the climate crisis or inequality that show up on the city's balance sheets, that's a sort of half that fiduciary obligations essentially leave out. What we have now is about $240 billion assets under management across the 5 funds. And you can see, I don't know how well you can see the pie chart, but it's about 3/4 in public markets, a little under half public equities, about a quarter, a little more in fixed income. And then the other quarter is private markets, the biggest share, about half being private equity, and then good chunks in real estate, private credit, and infrastructure, which are essentially private equity investments, but divvied up by sector. One interesting, so let me say a word here about our broad approach to responsible investing before I dive in a little more deeply on private equity and private markets. Obviously, as I mentioned, this concept of ESG has been very much in the news, mostly through the right-wing backlash against it. And I'm not going to talk too much about that, but I mean, just so you know what I think it's basically red state treasurers and politicians doing the bidding of their fossil fuel donors and cleverly coming up with a culture war that makes it seem like somehow they're on the side of working people when in fact they're on the side of country club elites and fossil fuel donors, but very cleverly executed. That said, it has very effectively executed with really, partly because I don't think people have been clear what responsible investing or ESG really is on the front end. What I'll say for us, and we're in a somewhat unique position because we're a universal owner. You can't, slide $250 billion into the marketplace any place quietly. We are broadly diversified across asset classes, across sectors, across geographies. So we're universal owners, which means we're more exposed to systemic risk than we are to company level or sector level risk. We're also a very long-term investor. Our obligations already run out to the end of the century because if a teacher starts teaching this year and is going to teach for 30 or 40 years and then have hopefully 30 or 40 years of retirement after that, that's the horizon of our obligation. So if you're a universal long-term investor tied to a public balance sheet, it really is systemic risk that your responsible investing program ought to be paying attention to. And that's how we try to view it. When we say climate risk is financial risk, what we mean is if we blow past 2 degrees of warming, we're going to burn up billions of dollars in our own portfolio in addition to the harm it will cause, and honestly, in addition to the extra money the city will have to spend to deal with rising seas and rising temperatures. We view inequality the same way as something that holds back the economy from broader thriving and therefore is appropriate attention for our ESG work. And workers' rights essentially the same way. For us, it's not a tussle between what share can investors pull and how will workers do. We are doing better when the economy is thriving broadly, and worker thriving is a part of that. So that's the approach that we take to ESG, is really to think of it as systemic stewardship. What are the steps that we can take, often in partnership with other public pension funds and large-scale asset owners, because you can't really be a systemic steward on your own. But I'll get to this when we get to our net zero plan. The more what we can do together is put shared expectations on managers and companies to achieve Paris-aligned decarbonization plans, the better chance we have of achieving that success. We won't craft a portfolio that achieves net zero. We will participate in systemic stewardship that pushes the real economy towards it. And we don't always achieve in that model of ESG. It's harder than it sounds. There's less rigorous thinking about what it looks like to do. I point people to some interesting work by Ellen Quigley on what systemic stewardship looks like and how you'd rigorously measure it if you were serious about it. I think it's a great area to think a lot more about in both public and private markets. But some examples here of the work we've done. We led a shareholder resolution last year at Starbucks in which 52% of investors voted for a third-party assessment of the company's labor practices. Apple agreed to do it without us having to take it to a vote. We've got a lot, so a whole bunch of those kinds of resolutions. The most fun thing, I guess, is the last one on here. We recently did securities litigation and sued Fox because the $780 million they spent on the Dominion lawsuit was the shareholders' money. Diving in a little on private markets, this is the $25 billion that we have invested across the 5 funds in private equity. The list is just one of those funds, so you don't have to see the duplication over and over. And this is only the first maybe 1/8 of the list. We have, well over 100 private equity managers. But probably, if you're from a private equity firm that manages for the New York City retirement systems, will you just raise your hands? All right, great. So a few folks in the room. But you can see Apollo, Blackstone, KKR, Vista, Warburg Pincus. We have an emerging manager fund that's managed by Neuberger Berman. So we've got a great private equity asset class team led by Anash Katsiela, but also really good teams in infra, in private credit, and in real estate. one interesting thing is that I led an effort to get us a little more room. You saw that we're about 25% in alternative investments. That's because a New York State law until last year capped public pension funds in New York at no more than 25% in alternative investments. After looking at what peers were doing and consulting with the team, I led an effort to get the legislature to pass a law increasing the room from 25 to 35%. We're now involved in strategic asset allocation that I don't think will go all the way up to 35, but will certainly go north of 25 across most of the funds. And the evidence suggests to us that we're going to achieve increased returns as a result. Now, that might be a little surprising to some of you who either watched my campaign or read the news. And even though I won the Comptroller's office basically because of an ad in which AOC and Elizabeth Warren and Jumaane Williams and Jerry Nadler say to vote for me. My work to put more money in private markets has angered some old allies, as you can see here. And even last night, I met with a friend who I didn't think of as on the left, who was played a big role in the early days of private equity, but now is an entrepreneur raising capital. And his gift to me was Plunder, which I don't know some of you have read. If you can't see the subtitle, it's Private Equity's Plan to Pillage America. And I think there are, of course, an interesting set of questions here. You guys know there's a perspective from which, what private equity does is saddles the company with debt, pulls it out of people's retirement plans and wage packages, and then sells it off to the markets, leaving the company holding the bag. And some of that happens, as you guys know. But as I dug in, what I concluded was there are a lot of things to be worried about, both in public and private markets, but that the form of capital ownership is not what determines will it be good for its investors, will it be good for its workers, will it be good for its stakeholders. Those are questions that you have to look at in each individual case, set some standards on, and try to drive progress. So if your goal is to be a systemic steward or a responsible investor, then you'll need a thoughtful program in both public markets and private markets. And of course, that will look different. In public markets, you're doing shareholder engagement and shareholder resolutions and proxy voting and sometimes securities litigation. In private markets, you're doing your due diligence with clear questionnaires up front about what you expect and research on what comes out, and engaging and making sure you understand what's being bought and whether it's living up to the standards. And you get a lot of opportunities to do that because you'll stick with your funds over and over again, and they'll want to know if you invested in Fund 2 that you're feeling pretty good about it when they come back for Fund 3, and that because you are a much bigger, or at least we are, a much bigger provider of capital for our private market GPs, we actually have a lot more ability to engage with them, a lot more likelihood that they will care what we think than we do in public markets. So we have tried really hard to build out a private markets policy on ESG, in climate, in workers' rights, on property management and affordable housing that we are really proud of. And I'll tell you just a little bit, mostly about climate, and then a couple of words on those other two, and then take some questions. So earlier this year, we issued our net zero implementation plan with a plan to get 3 of our funds to net zero by 2040. They had already divested fossil fuel reserve ownership in their public equities holdings, but that was only about 2% of the funds. So thinking seriously about what decarbonization looks like required thinking about the other 98% of the portfolio. It's a 4-part plan, set targets to net zero and disclose annually. And that's more complicated than it sounds because, we want to get to Scope 3 disclosure as well as Scope 1 and 2. That's got some technical complexities, but we're insisting on it. So we've set clear pathways on Scopes 1 and 2, but we're disclosing on Scope 3 from the start. Second is to engage with both our asset managers and portfolio companies to make sure they're serious about their plans. I just give you one sectoral example. In utilities, 90% of our utilities companies have made a Paris commitment, but only 11% have science-based targets to get there. So we've engaged with the sector to say, we expect by next June 2025, that all of the utilities companies companies in our portfolio will have science-based targets across scopes 1 and 2, and scope 3 targets by 2030. Scope 3 targets and disclosure by 2030. And we're engaged in a really good discussion with them because they aren't so sure that SBTI's framework is the right one, and we're pushing back and forth so that we really can get there in both public markets and private ones. We're dramatically increasing our investments in climate solutions, and we have divested fossil fuel reserve ownership, both from our public equities holdings and upstream private market holdings, or at least I'm putting a bar on future investments in private markets. And we can go back and forth in questions if you're interested about why I think that's important. But I guess what I would say is, as we are doing the rest of this work, like I think the utility companies took it seriously on setting science-based targets because they see we're serious about this plan. So it's not only a question of are we increasing the cost of capital there, it's do we have a rigorous plan that holds together? And I think that's an important part of it. So what's the role specifically of private equity? Interestingly, as I mentioned, we probably got more attention for the fact that we did put in place essentially, we have said to our private markets GPs, we won't buy any more upstream fossil fuels. But of course, it's really on the climate solutions investment side where private markets are so critical. We are now at $8.4 billion of climate solutions investments. We're aiming to grow that to $50 billion by 2035, and the vast majority of those are in private markets. Here's a couple of examples from KKR and TPG Rise and Brookfield that are companies we're really excited to be invested in. We have some public markets climate solutions holdings to be sure, but our growth we really believe is coming in private markets, and without these investments we wouldn't be able to achieve them. We also have done a lot of work to set clear expectations for our managers, and so this letter is available on our website, so you don't have to try to read it on the screen. But what we've said to them is we're serious about this net zero by 2040 commitment. We want those science-based targets in place for scopes 1, 2, and 3 on this timeline. We understand that if you on average hold a company for 7 years, that it's hard for you to say what does net zero by 2040 or 2050 look like when you don't even know what you'll have bought by then. On the other hand, that is not a reason why you couldn't make a commitment that within the first year of buying a company, you'll commit that you will set science-based targets for them and get them aligned on a Paris plan, and that you will demonstrate that you could even buy something that boosts your footprint in the first year, so long as you have a serious and diligent plan to then put it on a pathway. And that's what we've asked for, folks. And we actually have gotten a lot of good responses. So we did a survey of our private equity managers, and you can see here what we got. 28% already measure scope 1 and 2 emissions for some of their portfolio, 15% for 100% of their portfolio, and 17% do some scope 3 emissions. I should say that scope 1 and 2, by 2025, we aim to have 70% of our financed emissions covered by scope 1 and 2 targets. So that's why we dug in on utilities so early. We're looking at the sectors that are particular contributors, and I think in everyone's portfolio, a pretty small share of companies are responsible for a pretty large share of your emissions. 15% of them have committed to be net zero by 2050. And about the same amount, 14%, have committed to science-based targets. And I do think that combination is critical. Like what we're doing at this moment is making the transition from I said I would get to net zero to here is a framework and a plan to have genuine management at the companies we own and to track every year whether we're getting there. We are working a lot with the Science Based Targets Institute, SBTI, but we've made clear we're open to other frameworks of measurement. They just have to be rigorous and serious. And on this, we're trying to team up with other large asset owners, especially other global public pension funds, some of the European and Asian ones, as well as partners here, because the more we could be aligned on the frameworks that we use, first, just the easier it is for everyone, but also a much better chance that our managers will pay attention. And we really think that's a big part of the way that we can add value here, and so that's what we're working at. And then a couple of closing words about two other areas. I know today is largely about sustainability, but I want to talk about workers' rights, which obviously is critical for a just transition, but obviously also critically important on its own. And one point here about the war on ESG that I'll just mention, part of why I think we've given kind of right-wing MAGA politicians so much running room to attack us is that it doesn't look like we are on the side of a thriving economy and benefits for workers, that if it only is viewed as about climate and something to do with Wall Street, it's not surprising that there would be a sort of populist backlash against it if we can demonstrate that what we're trying to do is make sure capital flows through the marketplace in, yes, of course, a way that attends to climate risk, but also flows through and make sure we get a more inclusive and equal economy that works for working people. We've got a lot better chance of reminding them what side they're on. So I mentioned some of the things that we have done in public markets where we brought actions at Starbucks, at Amazon, we brought one at Apple, but they agreed to do it without having to take it to a vote. What we're really trying to do is elevate workers' freedom of association as a standard for responsible companies, so that even though under U.S. labor law you're allowed to do captive audience meetings and try to oppose or bust the union, you're not under international labor organization standards. There's a freedom of freedom of association principle that a lot of companies have signed on to but don't follow. And so we've taken that as something that we want to elevate as a standard across the board in both public and private markets. But stepping back more broadly, what I would say is we believe that in that systemic stewardship role, helping nurture a good jobs economy, an economy in which workers get paid enough and have sufficient benefits to thrive, and there's relatively low turnover, is good broadly for universal investors like us. Some of that will come from unionization, but some of that comes from things like the good job strategy that Zeynep Tun and others have done real research on. And so we're looking at what can we do as investors to make sure we are investing in a thriving good jobs economy. So in addition to returns, if you have low worker turnover, if you promote to your frontline management from your employees, there's a set of policies that have been shown to be really good even in retail and service sectors and what are seen as low-wage work. And I refer you to Zeynep Tun's Good Jobs work if you want to learn more about this. But we're trying to do that in both our public markets and private markets. So in our private equity portfolio, a couple of wins so far. And my favorite here is the Venetian Hotel, which for 20 years was both the largest hotel on the Strip in Las Vegas and basically the only non-union one. It was owned by Sheldon Adelson. He sold it to Apollo a year or two ago. Apollo came to us for a re-up, and I went back to that chart I showed you at the beginning and said, you know what, I got to get a vote from some labor unions in order to make an investment in that next fund, so why don't you think about signing a neutrality agreement with the culinary? They did, and 5,000 workers are currently negotiating their first union contract. That probably is the biggest single ESG impact that I've had in my first 2 years in office. And it comes from our private equity portfolio. There are also some other interesting opportunities here, though. I put an image up from KKR's Ownership Works program, which is advancing worker ownership in the companies that they buy, which we also think is a pretty interesting model if done consistently with other principles. So there's a lot to do for workers. And then finally, kind of out at the edge of the most interesting things we're doing is a lot of our holdings in real estate and private equity are in residential real estate, single-family rentals, and some multifamily acquisitions where there have been real concerns about whether tenants' rights have been respected. And rather than pull our money out of concerns, we said to Cerberus, who I saw is here, and to KKR, and to Blackstone, and to Apollo, and to Related, would you be open to setting a set of standards of tenant protections, which are not going to be rent regulations, are not going to go as far as New York State's laws go, but which would be some basic standards that are sure a lot more than what exists today in Texas or Arkansas or Missouri, and make us feel like if we're investing in housing in those places, we're not buying housing, throwing people out, and bringing wealthier people in. We're running a good business that's nurturing effective residential real estate in those places. And I think we are on the cusp, knock wood, of achieving some good standards that I hope will get adopted across the industry, far beyond our portfolio, but that really come from taking a responsible investing approach in private markets and show what it looks like when you try to think with that systemic stewardship approach, not only in public markets, but in private ones as well. Thank you for giving me the opportunity to talk about it in a way that we haven't exactly before, and I will be delighted to take your questions. Yeah, okay.
I don't know if you can comment on this, but behind the scenes, are you seeing any deviation between anti-ESG investing legislation and execution in the CIO's office?
You know, I feel like you're seeing that more in public markets where people are just more visible. Like, there's no doubt that, BlackRock, Vanguard took a giant step back. They just didn't want to be in the debate, and so they withdrew from GFANZ. I've been very publicly frustrated with BlackRock putting the Saudi Aramco on the CEO on the board. And I really believe that they were more forward in pushing this stuff. And I'm not saying they're not still doing it; they're still doing a meaningful amount of it, but they're talking about it and championing it a lot less. In private markets, people are just less worried about retail investors and visible politics, so they know their LPs care about this. Other large pension funds do. The other thing to remember is the red states don't invest very much in their public employees, so they're like this much. Honestly, the red state folks who have been on that, not even who have pulled money out of BlackRock, but have even signed the letter, basically New York City, has more on deposit with BlackRock than all of the red states combined because they don't invest in the retirement security of their public sector workers. And the GPs mostly know that. So I don't feel like we've definitely seen people duck and try not to be in the newspapers, but we haven't seen people pull back. In private markets, we have not seen people pull back from commitments they've made to us.
Oh, yeah, just real quick, I guess I was thinking about someone in your role in a red state. Are they slow rolling?
Oh, well, first, they weren't doing too much implementation. In red states, they weren't doing much of this. They are trying to pull in the opposite direction, although I saw the most interesting thing last week. I think it's Oklahoma, where the Oklahoma Public Employees Pension System, every member on it except for the state treasurer are suing the state treasurer because he's trying to pull them out of BlackRock. And they recognize it's deeply inconsistent with fiduciary duty. So I'm hoping that plays itself out, but it's mostly just political noise that has some implications because you've got folks here who didn't sign up to be in the middle of a fight like that.
Brad, you're a gladiator in the big stage of our world, in the sense, and our European gladiators and stuff. But how do you see COP28 and some feedback from that? Did you go?
So I didn't go to COP28, but what we did do in between Climate Week and COP was worked with the UN. Sarah Bloom Raskin, and they had a set of panels that convened sectoral actors across the world to push on next steps. And so we worked with them on the large asset owner and public pension funds. So it was APG and AP7 and Temasek from Singapore and CDPQ and CalPERS and CalSTRS and us talking about this stuff. And how do we, I think this is an important next step for us, how do we as large public pension funds align as best we can? And that means a lot of things. So I can't remember if it's CalPERS or CalSTRS just released a pretty good set of definitions. What is a climate solutions investment? And they're more rigorous than we are. So I'm like, great, let's use their standards for what's a rigorous climate solutions investment. And we're taking the lead with utilities because those utility companies called us back. But I said to those folks, how about we all work together on what will be science-based targets in the utility sector and agree to use the same, measurement frameworks, and we're talking about whether we can add on to the questionnaires we use with our GPs. So that's what we're excited about. It will be much better done at global scale with the UN as a convening partner, whatever, and will be important whatever comes out of COP. Yeah.
I'm just gonna preface this by saying from a red state, we're not all awful.
Love people in red. Yeah, it's just your treasurers that I'm done with.
But I have a question about scope 3. So it's proving to be very thorny, and especially like we were talking about California earlier, even small medium businesses have to abide by. That's very expensive and difficult. I'm wondering like what you're seeing and where you are on that. It's very confusing.
Yeah, really an important challenge. So, and we've set scope 1 and 2 interim targets, but we haven't set scope 3 interim targets because we just don't feel like the data is sufficiently clear and standardized. At the same time, we have to do it. I mean, 70% of our emissions are scope 3 emissions. Just kind of in lay people's terms. Do people know what scope 1, scope 2? Yeah, all right, okay. But if you're not covering like the gasoline burned in people's gas tanks when they drive their cars around, you obviously are missing something pretty important in your measurements. So this is another place where I think if we get aligned, we can build a system that measures this better. Europe's ahead of us. I think California pushing is good, but we need a more uniform set of measures so it's not burdensome for small actors to participate. They can get the answers to those questions pretty straightforwardly, and we're not there yet. So this is one place where someone should start some companies that will go to our private equity fund managers and earn some money creating measurements in the world that the rest of us can use. And we've seen a lot of that. I guess maybe I should just say this, like it's not just scaling up, climate solutions is fun to see the numbers growing. That's what's happening. Sure, some people are doing the more like get solar everywhere and get EV charges everywhere, but there's a lot of innovation, and this is a place where we need some more. We need better technologies for rapid scope 3 measurement and disclosure, and that will be one important part of helping all of us hold to these goals. Raj.
Thank you for this. Question more generally about PE. You didn't mention anything. You mentioned a little bit more, obviously, as an endorser. But what about regulation of PE just more generally?
Yeah.
Is it fair to say that your presentation is within the four corners of how PE is structured today? You didn't mention fee structure at all. Are you engaged or your office engaged in that debate?
Yeah, it's a great question. We were one of the relatively few limited partners who did write a supportive comment on the SEC rulemaking process in a funny way that's a little bit counter to our own narrow interest. We are a very large, sophisticated, we got a great team both in our legal office and in our asset class heads. So I know we're getting better side letters and structuring better deals than average. And it's a funny thing when I asked how it is we know that we're getting good returns, and they're like everything will be fine so long as we just only have top quartile investments. And I'm like, well, the economy can't work that well if you have to have that's like Garrison Keillor or whatever, where everyone is above average. But I know we are, because we just are big enough that we can be. That said, it is not good for the capital markets to have hidden fee structures, and some people are getting side letters and other people don't know what's in them. You can price based on volume of investment, but you should do that more transparently. So we support the transparency that the SEC is pushing, which we think will be beneficial in the capital markets, even if it pinches us a little. Maybe I'll end, the guy that gave me plunder last night. So, what he said, he spent he got rich in private equity, but now he's running a biogas business and he's trying to raise capital. And he's like, Brad, you're getting fleeced on these fees. I'm telling you, you don't think you are. And I'm like, no, I did a really rigorous study. And, this is a little crude, but I think the simple way to think of it is over the past 15 years, my public markets performance has been plus or minus 7%, and my PE performance has been like plus or minus 10%. And he's like, well, they're charging me 18%. And so, that's the cost of capital to him. So I think there are, a lot of interesting questions, and whether that's that more LPs need to team up. here too and ask questions about how that money is being spent, because obviously we want that capital put out into the markets as efficiently as it can be. I'm not saying it is what's happening, but if what were happening was 3, 4, 5% of that is, disappearing between folks on the ground and its investors, that's jobs we're not creating and innovation we're missing. And so I think these are great questions. I'd love to learn more about them from people that are thinking creatively, because my lens is it a good thing to hold across our asset classes? And I concluded that it was, and that's why I pushed on the basket clause. And I support more disclosure, but I think beyond, if you go back to that question of systemic stewardship, I know it's true in climate, I know it's true in workers' rights, I think it's true in efficient capital markets as well, and a good thing for all of us to do, especially here at a business school, would be thinking, what are the practices that make our capital markets work as efficiently as they can? Thank you so much. I won't hold plunder up in the picture.
Thank you, Comptroller Lander, for your remarks and for all that you do, not only for our city, but in your leadership across the globe. Thanks for joining us here today.